Imagine waking up, checking your phone, and seeing money that landed in your account overnight. You did nothing. You sold nothing. That is dividend investing, and today you will finally understand how it actually works. Here is the idea in one sentence. When you own a share of a company, you own a tiny slice of that business, and some businesses send a piece of their profits back to you, in cash, just for holding the stock. That cash is called a dividend. It is not a trick. It is not a scam. It is simply your cut of the profits. Big, stable companies have paid these out to their owners for over 100 years. Let us break down the mechanics so nothing feels mysterious. A company earns a profit. Its leaders decide to keep some of it for growth and hand the rest to the shareholders. That handout is the dividend. Most companies pay you 4 times a year, once every quarter. So if a stock pays $4 a year in dividends, you get roughly $1 per share every 3 months, deposited into your account automatically. You will hear one key number constantly, the dividend yield. It is just the yearly dividend divided by the share price. A $50 stock that pays $2 a year has a 4% yield. Yield is how you compare income across stocks. A 4% yield means for every $100 you invest, you get $4 a year back in cash, on top of any gains in the share price. There are 4 dates that confuse every single beginner, so let us make them dead simple. Together, they decide whether you actually get paid for any given dividend or whether you just miss it. First, the declaration date. This is just the day the company announces, we are paying a dividend, and here is how much it will be. Think of it as the official heads up that a payment is coming. Second, the ex-dividend date. This one matters the most. You must own the stock before this date to get the payment. Buy it on or after that day, and you miss this round of dividends completely. Third, the record date. This is when the company checks its books to see who the official shareholders are. And fourth, the payment date, the day the actual cash finally hits your account. Honestly, remember just one of these, the ex-dividend date. Own the stock before that day, and the dividend is yours. That single rule saves beginners from almost all of the confusion around getting paid. Now here is where it goes from nice to genuinely life-changing. Instead of spending those dividends, you use them to buy more shares. More shares pay more dividends, which then buy you even more shares. This is called a DRIP, a dividend reinvestment plan. Most brokers let you switch it on with one single click. From then on, every payment quietly buys more stock for you, automatically, without you lifting a finger. This is compounding, and it is the most powerful force in all of investing. Your money makes money, and then that money makes money too. The snowball starts off slow, then grows shockingly fast. Let me show you the proof. Consider a classic dividend payer like Coca-Cola. An investor who bought shares decades ago and reinvested every single dividend would have multiplied their original money many times over. Studies of the stock market going all the way back to the 1930s found that reinvested dividends made up a huge chunk of total returns. In many decades, they were close to half of everything investors earned. Read that again. Roughly half of long-term stock market gains did not come from prices going up. They came from dividends being paid out and reinvested over time. That is how quietly enormous this really is. But there is a dangerous trap here, and beginners fall into it constantly. A sky-high yield is not automatically a good thing. Sometimes that giant number is actually a bright flashing warning sign. Remember the formula. Yield is the dividend divided by the price. If the stock price crashes, the yield shoots up. So a 15% yield often just means the market expects that dividend to be cut soon. This is called a yield trap. You chase the big juicy number. You buy in, and then the company slashes its dividend, and the stock keeps right on falling. Now you are losing on both sides at once. So do not just hunt for the highest yield you can find. Instead, look for companies that have paid and raised their dividend for many years in a row. Boring consistency beats a flashy number every time. There is even a name for the elite group. Dividend Aristocrats are big companies that have increased their dividend every single year for at least 25 years straight. That is a serious track record. Think about that. Decades of raising payouts through recessions, crashes, and crises. It does not guarantee the future, but it shows a business that is built to reward its owners year after year after year. So how do you actually begin? Step 1. Open a brokerage account. It is free, it takes about 10 minutes, and you can do the whole thing right from your phone today. There is no excuse to wait. Step 2. Decide what to buy. You have two simple paths. You can buy individual dividend stocks yourself, or you can buy a dividend fund that holds dozens or even hundreds of them in a single click. For most beginners, a low-cost dividend ETF is the easier and safer place to start. One purchase spreads your money across many payers, so no single company cutting its dividend can ever sink your whole plan. Step 3. Turn on automatic reinvestment, the DRIP we just talked about. Step 4. Set up a small automatic deposit every single payday. Even $25 a week is enough to start the machine running. Let me keep you grounded so you do not quit too early. Dividend investing is not a get-rich-quick scheme. In year 1, your payments are going to feel almost laughably, embarrassingly small. That is completely normal. A few $1,000s invested might pay you just $100-something a year at first. Do not let that discourage you. The real power is not in year 1. It is in year 10, 15, and 20. The investors who win at this are not the smartest people in the room. They are simply the most patient. They keep buying, keep reinvesting, and let time and compounding do the heavy lifting in the background. One quick but important note on taxes, because the tax man always wants his cut too. In a regular brokerage account, your dividends are counted as taxable income in the same year that you receive them. But inside a retirement account like a Roth IRA, qualified dividends can grow and compound completely tax-free. For many beginners, holding dividend investments in there is a powerful and perfectly legal edge worth using. I am not giving you personal tax advice, and the rules do change, so confirm the specifics for your own situation. But know this: where you hold dividend stocks can matter just as much as which ones you pick. Let us lock it all in. Dividends are your cut of company profits, paid to you in cash. Yield tells you the income rate, and you must own the stock before the ex-dividend date in order to get paid. Reinvest everything to trigger compounding. Avoid the yield traps and chase consistency, not flashy numbers. Start with a low-cost dividend fund, automate the whole thing, and then give it years, not just weeks. Do all of that, and you slowly build a money machine that pays you whether you are working, sleeping, or sitting on a beach. That is the real goal here. Income that shows up without your time attached to it. If this finally made dividends click for you, smash that like button, subscribe for more simple money lessons, and share this with one friend who needs it. What should we break down next? Tell me down in the comments.